This year is off to a very interesting start. This past April 2nd, 2025, on the so-called Liberation Day, President Trump shocked the world with his list of tariffs. Nobody got off the hook. Even the Penguin Island in the Antarctica got hit with them. However, Asian countries were the ones hit with it the most, especially China. To start, President Trump started with a 10% tariff on China. Then it went up to 20%, then 54%, then 104%, then it went up to 145%, and eventually it went all the way up to 245%. Although this last one was imposed on syringes and electric cars imported from China. But China didn't sit still. They also retaliated back to the US. It's like watching the two countries going at each other in a boxing match. And the market was going crazy. Look at the stock market right here. We have the S&P 500, the NASDAQ, and the Dow Jones. The entire market was like a roller coaster. First, we got April 2nd, where the Dow closes more than 200 points higher ahead of Trump's tariffs rollout. But then on April 3rd, the Dow nosedives 1,600 points. The S&P 500 and the NASDAQ dropped the most since 2020 after Trump's tariffs onslaught. Then on April 10th, the Dow tumbles 1,000 points, wiping out a chunk of Wednesday's historic rally. And the market kept going up and down and up and down. I don't know about you, but I actually lost track of all that drama at this point. I cannot control how the market is going to react or what these two countries or the world is going to choose to do. But what I can control is where I will invest my money to protect myself from all the ups and downs in the market. And that's why I'm creating this video to help you make a decision on how to protect your money. Welcome to Nova Rice, your channel for financial education. In here, we talk about investments in real estate, investments in the stock market, in precious metals, and small businesses. To start, I want to talk about the different type of investments that you should have in your portfolio according to Robert Kiyosaki, author of Rich Dad, Poor Dad, and also my mentor. So first is real estate. I mean, this is a real estate investment channel, so it's a no-brainer that it will go first on the list, right? Then you should have a business as a way to generate income so you can keep investing and also to make a living. Next is to invest in stock and bonds because these are going to provide rapid liquidity when you need it. And last but not least, commodities, particularly precious metals, at least in my case, right? Now, the reason why he refers to 4 quadrants, it's because no investment is 100% safe. So you want to position yourself to have different type of investments in your portfolio so that way you have somewhere to choose from in the event that you do need to liquidate any of those assets. The whole point is to give you options so that you don't have to liquidate an asset at a loss. Because finding yourself to have all assets losing value at the same time is very minimal if you're well diversified. For example, let's say you need to liquidate your assets and you need money immediately because of a family emergency. But it just happens so that at that time, the stock market is not doing so well and you're losing a lot of money. You don't want to liquidate in a time like that because you will be at a loss, but hey, you need the money. So it's not like you have another option. Well, you do if you're well diversified. Let's say you bought gold, so you have both in your portfolio. And these two tend to have an inverse relationship. So if the stock market is not doing so well, gold typically goes high because it's considered insurance. And that's what makes diversification so powerful. You want to have options. So that way, if one asset doesn't work out, you can still fall back on another one. And if you have all 4, hey, 4 options is better than just having one or none at all. So now, let's dive into each one of them, starting with real estate. There are various ways to invest in real estate. The most popular one that people know about is by investing in the actual hard asset. By that, I mean the actual property, right? So let's say you buy a house or a multifamily and you put it out in the market, right? So within this hard asset, you can invest your money in your primary residence, right? Let's say you buy a single family home and you find yourself living in a big house with plenty of other rooms. You can actually put one of the rooms up for rent and have a roommate instead. Or let's say if you live in a city like New York where parking it's very limited, you can actually have the garage space and rent it out for a monthly income. Another creative way to go about it is by investing in a multifamily property. So let's say, for example, you buy a 2-family or a 3-family or a quad, a 4-family property. You get to choose to live in one of the apartments and rent out the other ones. So that way the asset in itself is helping you cover the mortgage, and at the same time, it's helping you build equity. And that's how you actually protect yourself from crazy times like this, because now you have an asset that's generating money for you. Now, depending on where you are, I understand that not everybody has the down payment for the purchase of a property, which typically range from 5 to 25% of the purchase price. For those who are either getting started or have a lower budget, there are other options that you can consider. One of them is investing in an ETF, which stands for Exchange Traded Funds. For those who don't know what ETFs are, let's think of it as a basket of different securities. In this case, a basket of real estate securities that you can invest your money and enjoy the benefits of making your money grow. Now, with this type of investment, you don't get to have control of the asset in itself. You're just basically investing in the security and just enjoying the returns. That way, you don't have to deal with selling a house or dealing with tenants or any type of property maintenance. If you don't know what type of ETFs to invest to get access to real estate, here is a list courtesy of NerdWallet that you can check out and see which of them will meet your investment criteria. So feel free to pause this video and write down the list, or just simply take a screenshot so you can evaluate those at a later time. If you're still exploring for other options, you can also look into Fundraise, which is a crowdfunded alternative investment platform for small investors. In other words, it is a platform where you can invest your money and their team will take your funds and invest in real estate. That way you will get access to the returns without necessarily getting all hands-on and involved in the property selection or the property management process. I have invested in Fundraise myself, and here's how my investment has been evolving over the years. So first, I opened my account in 2019, and I made a original contribution of $500, right? Here, you will see the section where it says account value. It grew to 526. So I made 26 cents that year. I left my money there. In fact, I didn't pay any attention to it until the following year. And then when I checked on it, I figured, let me just add a little bit more money. So I added a little bit more, and my net contribution at the time, meaning the money that I put towards my Fundraise account, was $968. That's the money that came out of pocket. And my portfolio grew to $1,005.01. providing me a net return of 37 cents. So, I mean, it was good, but I wasn't too crazy about it. I just left it there. I figured, let me not liquidate and see how it will keep evolving. And then 2021 came, and I decided to do nothing. So my net contribution was still at $968. By then, the account grew to $1,066.99, and I got a net return of $98.99. The return, it's actually on paper because I still didn't liquidate anything. So I just left it there and see what would happen the next year. Then 2022 came, I still did nothing, but then my account value went up to $1,273.85. So by then I got a return of $305.85. And so I thought, oh, numbers talk. So let me put a little bit more money to see how it will look the next year. So by 2023, I made a net contribution of $3,468, and the account value with all the growth and stuff went up to $3,866.61, and I got a net return of $398.61. Then on 2024, I added more money into the account. So I had a net contribution of $5,768. And then the new account value was $6,206.09, providing me with a net return of $438.09. Then 2025 came, I added more money, and my new net contribution was $7,168. And at the time of this episode recording, the account value is sitting at $7,892.54 with a net return of $724.54. That's a return of roughly about 10%. For those who are interested, I'm going to leave a link down in the description box for you to check out the Fundraise page. Now, next on the list, let's talk about stocks. It is no surprise that the easiest way, quote unquote, to make money is by investing in the stock market. All you got to do is just to put your money in and just see it grow. But given what has been happening lately, some people might think it will be crazy to put your money in there, seeing all the ups and downs, and you might actually lose money. I mean, once again, investing comes with risk. There's no asset that will guarantee you a return whatsoever. It's all about making an informed decision. And the thought of investing in the stock market right now could probably be crazy, but if you're making an informed decision, you're actually buying some of the stocks at a discount, which will benefit you if you're investing in the stock market long term. Now, day trading, it's a complete whole different monster. I'm talking about stock investments that you get to hold for years to come. And if that's the case, whatever loss you could be experiencing is going to be made up for as the years go by. And if you're entering the market, making an informed decision today, chances are you're getting some of those stocks at a discount. Now, if you're brand new and if you don't know where exactly to invest, here's an ETF that I like a lot. It's the Vanguard S&P 500. I've been investing in it since 2016, and so far I've gotten pretty good returns. And for those who are brand new to this whole world of stock investing, ETFs can be created basically on any industry. It could be just for real estate, it can be just for commodities, and this is one that follows the S&P 500. So that way you have a pool of different companies in one package, and you get to invest in pieces of those multiple companies. And the idea is that if one company doesn't do too well, then at least there are the other ones who will balance each other out. So that way you're not drastically losing all your money all at once. But again, investing comes with risk. This has been an ETF that has worked for me, but it might not necessarily work for you. So if this one is not your favorite, tell me which ones you're buying right now so we can share it with all the viewers. Let me know which one those are and why do you like them so much. And within this category, although not the same, are bonds. Now, for those who are brand new, I want to take a moment and explain the differences. So stocks and bonds, they're both investments, but they're not necessarily the same. So let's say, for example, you have a company and you need money, you need liquidity. So what you do is that you issue debt. You say, hey, I need to borrow a certain amount of money. And then here is a piece of document that's going to say how much money I got from you, right? So you issue those bonds. And then in exchange, you will get the money from investors. And then after a few years, you will repay them that money back with interest. That's one. Another way to raise money or to create liquidity for your company is by giving up equity through stocks. So let's say, for example, if you don't issue any stocks, you will be 100% owner of your company. But let's say you're thinking about issuing some stocks because you have no problem issuing equity. And let's say in this instance, you want to issue 20%. So now you are 80% owner of your company. And then the remaining 20% is owned by the different investors who decided to invest in the account. Now, depending on your preference, some might say, hey, I prefer to buy stocks because the returns are higher. And yes, the returns are higher, but you will also risk losing all of your money. Here's how it works. So let's say the same company that we're talking about, some people decided to buy bonds and then some people decided to invest in stocks. And the company all of a sudden goes bankrupt. Guess what? Bondholders will always get paid because debt always gets paid. So whenever a company is declaring bankruptcy, they always have to pay their creditors. And that includes lender, banks, and bondholders because you are a creditor. You're given them money in exchange of a bond. Then after paying everybody, including bondholders, whatever's left of the company money, that goes to the equity holders, in this case, the stockholders. So sometimes you've seen instances in where a company go bankrupt and stockholders, they lose all their money because hey, after liquidating everything, there was no money left. So yes, you do get to enjoy making more money when you invest in stocks, but you also risk losing everything. Now, which of these two is better for you? That usually depends on your risk tolerance and also your age. For example, younger investors tend to prefer investing in the stock market because it gives them higher returns. And at the same time, because they're so far away from retirement, any money that they get to lose, they have the opportunity to make up for it over the years. Now, if you are closer to retirement, you will probably not want to chance your money here in the stock. You'll probably want to park it in assets that are considered more secure, even though you're going to get a lower return, but you want, quote unquote, something that is more guaranteed. You know that eventually you're going to get that money back plus interest. That's why U.S. Treasuries are so popular among investors as a safe haven. People from all over the world buy U.S. Treasuries to protect their money. Now, like I said, not all assets are bulletproof and no asset is free of any risk. So even bonds will experience its ups and downs, just like it happened with the SVB fiasco, where a high volume of bonds entered the market at the same time and the bank just basically disappeared overnight. Now, the next investment on the list is your business. I know part of our audience are actually business owners, so congratulations for your business. But if you're still an employee, don't worry, because your business is your brand. This is how you stand out and you attract different job offers. So don't exclude yourself from this pool, because your business, it's whatever you're fully invested in to make a living out of it. Now, for those who actually have a brick and mortar or an actual business, you will probably become familiar with a document called the balance sheet and a document called the net income statement, right? So the balance sheet, it's basically for all of your assets. Think about, let's say, for example, you own an office space. And in your office, you have computers, you have desk, you have a couch, and you have seat. All of that are part of your assets, because you need to have that for the business to function properly. So in your balance sheet, you should have a nice list of assets that includes furniture, a good savings account with enough funds in there. So that way your business has assets in itself, something that they can liquidate in the event that you default on the payment. Now, the second document that is equally important, if not more, is the net income statement. That's how businesses get to see how much money you actually make and how many expenses you incur during the year. And if you're even a profitable business, because if you're no profitable, then chances are that you might not be able to pay back the loan. Now, why am I making so much emphasis on this? Well, like I said in the intro, we live in very crazy times. The market, it's up and down, extremely volatile. So we want to make sure that we protect ourselves and the liquidity of our business by getting access to enough cash when we don't need it. Because when you don't need the money is when you're actually financially sound and lenders find you financially attractive, versus when you're desperate for money. That's when lenders typically don't want to do business with you because you're probably in financial stress. So it is very important that you maintain a good balance sheet and a nice net income statement and start qualifying for different business line of credit. In fact, Anthony and I apply for 2 different lines of credit for our business because honestly, we don't know what to expect. We don't know if a recession is going to hit or maybe not, or I don't know. And so we rather be ready with this line of credit. And the beauty about having a line of credit is that you only pay based on what you use. So we had 2 business line of credit parked on the side, ready to go in the event that our business becomes affected by whatever market volatility comes. So now I'm creating an additional source of funding and I wouldn't necessarily have to liquidate my assets. The company that we work with is National Business Capital. They helped us secure the different lines of credit. So if you're in this bucket where, let's say your business is already established for more than 2 years, you have your business taxes in order, you have your balance sheet in order, and everything else in order, then this is a great time to get your business line of credit ready and just parked on the side. You don't have to use all that money, but just be ready in case something happens. The worst that can happen is that you won't use that money. But let's say you're a business owner and you don't necessarily are established for over 2 years. You're just getting started, but you want to protect yourself. You don't know anything about a balance sheet or a net income, and that's okay. You don't need to know that if you're getting started. That's why you're here, to learn about it. If that's your case, you can actually work with business credit cards. There's a service that we have been working with for years, and that's Fund and Grow. Fund and Grow is a done-for-you service that helps small business secure up to $250,000 worth of business credit cards. You can utilize those business credit cards to buy inventory, to pay your staff, to pay the rent of the business. And the beauty of it is that because these are business credit cards, the usage of those credit cards don't impact your personal credit. Yes, you will need your personal credit to get started because since the business is new, you will be the face of your company. So you need to have good credit in order to qualify for those business credit cards. But once you qualify and you're settled and you start using the capital made available to you through those business credit cards, the usage of those credit cards won't negatively impact your personal credit because they're being reported to the business credit side of your business instead. And to make it even better, these business credit cards come to you at a 0%. That means that on the usage of them, you don't have to worry about interest because those business credit cards come with an introductory rate of 0% that could last up to 12, 18, sometimes even 24 months if you're lucky. So depending on your situation, whether you're looking for an actual business line of credit or looking for access to business credit cards, I'm going to leave the link down below to both services in the description box and in the comment section below for you to access them. Next asset that you should invest in to protect your money is commodities, particularly gold. Now, I'm sure you've been paying attention to what has been happening in the stock market with all the ups and downs, right? So if you pay close attention to what has been happening to the stock market, I want you to compare it to what has been happening to gold. You will notice the inverse relationship. As the stock market is sinking, the gold value goes up. And that's what I meant by being well diversified. So let's say you have both type of assets, and in the event that you need to liquidate and the stock market is not doing well, you can choose to liquidate your gold and get access to that cash. Just to tell you a little bit of an anecdote, when Anthony and I started buying gold, that gold was $1,900 per ounce. And that was back in 2019. Today, 1 ounce of gold is over $3,000. And depending on when you might be watching this episode, the price will be very different by then. And since you stay all the way until now, I want to share a bonus for you. Another tool that I like to use to protect my money, to protect my net worth, is investing in life insurance. I know that this whole concept of life insurance has created a lot of controversy because people hear life insurance and might think, hey, I need to die for this and so other people can enjoy my money. No, the thing with life insurance is that you need to know what product you're actually investing in, right? If you buy a term life, which usually goes for 5, 10, 15, 20, sometimes even 25 years, yes, that type of policy is typically the cheapest, the most affordable, but chances are you're most likely going to outlive that policy. So let's say, for example, if you bought a term life insurance for 5 years, and if after 5 years nothing happened to you, then you lose all that money. So it's sort of like a good thing because you're still alive, but hey, here's money that you're never going to get back. So those are not the type of life insurance that I'm talking about. When I talk about life insurance, I'm specifically talking about whole life and index universal life. These two type of life insurance, they, yes, do protect the benefit for your loved ones in the event that something happens to you, but you can also enjoy those while you're still alive, because it gives you the option to accumulate cash value. As you're putting money away to fund that life insurance, there is cash value being accumulated to it. So that way, in the event of an emergency, if you need to get access to that cash, you can rightfully do so by borrowing against the policy and use that cash for any liquidity needs that you have. Now, this is not an investment vehicle and is not to replace the other type of investments that I talked about earlier. This is strictly for insurance purposes. It's just that you get to also enjoy a nice added bonus of having access to cash. But this should be the last item on your list. This type of product is usually purchased by high net worth individuals who look for a way to park their money elsewhere. In fact, just to give you an example, let's assume that you have a business and there are two partners right there. So 50-50. One partner buys life insurance on the other partner and vice versa. So if any of the two of them gets to die and then the family can't really handle the demands of the business, the partner who's still alive has the option to use that life insurance and purchase the equity of the other partner and just give the money to the family who's still alive. So that way this person bought out the other half and the family gets to receive the payout for the purchase of the ownership of that other half of the company. Thank you for joining here. And for those looking to learn more about National Business Capital or Fund and Grow, here are the videos right here that you can check out.